Hello, Professor. How you doing?
Good. How are you?
Pretty good.
Awesome. All right. So let's get us started. All right. So hope you guys had a great week. Uh, well, the stock market certainly did, despite the today's pullback. I'm not sure if you guys remember during our discussion last week, I shared my view on Tesla. It turns out my analysis was kind of correct, right? So not surprisingly, the stock price dropped at least 15% over the past few sessions. So anyhow, my point is it's a very unusual time. Let me show you something right here. If you look at the rate index right now, you can see, oh, can you guys see my screen?
Yes.
Yes.
All right, yeah. If you look at this index, which captures the overall market sentiment, you can see it's extremely positive. And I personally view this kind of outcome to be a sort of dangerous sign. At least I personally am not that positive. Okay, so well, I just want to remind you that when you read up your report for the corporate analysis for the VS trading game, you want to incorporate some sort of a discussion on the overall market outlook. Okay, I think that's extremely important when you pick up your companies and implement your analysis. Okay, right now I feel like the overall market sentiment is how to say, it's kind of biased. I personally am not that positive, but anyhow, I will keep you guys posted next week in terms of what's going on right now. Today we do have lots of material to be covered, so I don't want to spend too much time on the market overhead. But again, I want to remind you that if you haven't started your report, you should be able, you should start put things together pretty soon because it's going to be in December 3rd, only a few weeks left. Okay, all right. So last week we talked about the stock valuation. We went through a few valuation models. So in today's lecture, I think it's going to be very interesting. We will talk about the other form of corporate securities, which is options. Okay, so I want to let you know upfront that in many other corporate finance textbooks, usually options as a derivative is not covered in the corporate finance. But in your textbook, it is there. It is in chapter 22, which I feel like it's very necessary to bring this up to the table because it truly provides us a sort of a new valuation paradigm that allow us to better understand the corporate decision makings in different areas such as capital structure, capital budgeting, incentive design, and mergers and acquisitions, so on and so forth. Okay, so there are actually many different other courses covering the options like investments, derivatives. But in this lecture, I'm going to give you guys some sort of intuition in terms of what's going on behind this instrument and how we can use to implement some sort of corporate analysis, okay, under the corporate finance context. Okay, so that's going to be the focus. So today I will talk about, I'll spend a few minutes talk about the motivation, why we need options and what are the basic functions in terms of the options. And then I'll talk about the basic concepts, go through a few terminologies related to this instrument. Then I think we need to discuss a little bit about the option strategies. The point about this discussion is not to, teach you the trading strategies. Instead, I want to kind of give you some sort of a deeper understanding in terms of how the combination of options that allow us to generate a variety of pricing structures, which could be meaningful for your, financial analysis. Okay, so the fourth building block is going to be the corporate finance implications. So basically, how to view corporate liability in the asset as a sort of option. Okay, the last building block is going to be the optional learning material, which is not required for this course. But if you are interested in this area, you're more than welcome to take a look of lecture notes. Okay, so speaking for the options, the first thing I want to mention is it's virtually everywhere. Okay, so for the majority of the financial instruments, you can view them as a form of options. Okay, I will come to that. And the other thing I want to throw ahead is that option can help us to lower the risk. Okay, in the meantime, options are also very risky because it incurs substantial amount of leverage. Okay, it's a very risky instrument, but if you use properly, you can manage your risk effectively. Okay, it is also very healthy for the price discovery mechanism and allow the market to be more transparent. Okay. In addition, I want to say that if you call stocks and bonds as a form of individual tools, then I want to say option provides you a full toolbox that allows you to to present a full portfolio that can generate income and preserve capital. Okay, and as I mentioned, options provide us a new analytical valuation paradigm in the corporate financial world. Okay, so it is a very powerful tool that can be used in many different areas. Okay, so in corporate finance, if you are evaluating the feasibility of whatever project, you can view that project to be a form of option. Okay, in the area of let's say mergers and acquisitions, well, one typical instrument is what we call the earnout. So basically, for the seller of the company, a part of their selling price is dependent upon the firm's future performance after the M&A deal. Okay, so it's virtually a call option. Okay, and also many large companies, they use the options as a sort of incentive instrument by properly incentivize corporate managers to take appropriate amount of a risk that could be healthy for the firm's growth. Okay, so actually options can be used in virtually many aspects of corporate finance, and I highly encourage you to read one of the example in your textbook, section 20 to 11. It basically tells you how to evaluate a corporate project from the perspective of real options. Okay, I will leave that to you after class. Okay, so speaking to the structure of the options, we have call options, put options, and we can sell an option, we can buy an option. Okay, so what is an option? Before I go before I jump into the detail, okay, anyone can just without look at my screen, give me a sort of a generic, intuition of what is an option. Okay, try to use your own words. What is an option? Any thoughts? I think it's sort of apropos, right? Try to use your own language, explain what is an option under the financial context.
isn't an option kind of like a contract you have with a contract to like buy or sell 100 shares of a stock, something like that?
Uh, uh, yes, pretty much that's the idea of an option on a stock. Okay, well, the underlying asset could be in different forms. Okay, so options in general is a form of a contractual relationship that allows you to have the option but not the obligation to enter a transaction to either buy or sell the underlying at a pre-specified date or before the pre-specified date. Okay, so the underlying asset could be stocks, could be many other forms of assets. Okay, so it is a derivative. By derivative, I mean it is derived from the underlying, or what we call the primary or fundamental. Okay, so basically you have the option where the payoff is dependent upon your underlying assets price movement. Okay, so suppose you have, let's say you are looking at a call option with a strike price of $50 on a stock where the current price is $40 3 months from now. Okay, so basically it allows you to, it gives you the option to buy that stock at $50 3 months from now. Okay, even though the current price is $40, you still have the, there's still a chance that the stock price can go beyond that 50 bucks. Okay, if it go beyond the 50 bucks, well, you will be very happy. How much happy you will be? It's going to be $10 happiness, right? Because you can buy the stock at $40 level where the market fair value is $50. Okay, so there is $10 per share profit over there. Okay, so this is just a general idea of the call option. Where the put option, yep.
Why would somebody let you buy their stock for less than its current value? Do you pay up front to have this option to offset risk?
Exactly. There's no free lunch. You have to buy that option up front. So we call that amount to be the option premium, which is the price of the option. Okay, so in order to enter this contract, you have to pay. Okay, it's not a free lunch. You can enjoy the benefit of this call option without paying anything. There's no such a beautiful thing. Okay, so you have to incur an amount of option premium upfront. Okay, so the payoff of a call option is very straightforward. It's either zero or the difference between the start price and the strike price or the exercise price. Okay, so by strike price, it refers to the pre-specified price on that contract. Okay, where you have the right to buy the stock. Okay, so if the stock price exceeds the level of the strike price, you can use that. You can implement. You can exercise your option where you benefit from the the price difference. Okay, if the stock price is not does not exceed the the exercise price, well, you don't have the obligation to exercise your call. Okay, you just let it expire. Worthless. Okay, so the payoff in that case is going to be zero. Okay, it's totally different from the payoff structure. The payoff structure we learned in the equity and bonds is completely different. Okay, later on I'll show you a few diagrams to visualize the payoff structure over there. Okay, the put option is the other end of the spectrum. Basically, it allows you to sell the stock at a pre-specified price. Okay, So let me show you one example to better motivate the idea of an option. Okay, so virtually for options, you can view it as a sort of insurance. Okay, so let's take a look at this put option on Facebook. Okay, now it's called Meta. Okay, so for Facebook, if you look at the stock price of Facebook on November 1st, a week ago, it's traded at the 330 level. I think today is 328. If you are going to, if you are an investor of a company of Facebook and you're concerned about the potential drop of the stock price, okay, because of there are lots of bad news going around the Facebook right now. Let's say you are very concerned about the downside risk of Facebook, and you want to make sure the stock price is never going below 315. Okay, so you want to protect your downside. Okay, let's say you buy a put option on the Facebook with a pre-specified strike price of $315, given the current stock price of 330. Let's say 3 months from now. Okay, now here on the screen I listed typical terms of an insurance contract. Okay, so think about this. What is the asset you are insured? That's the Facebook, the stock, right? What is the current asset value of the asset you are insured?
330.
Exactly. Thank you. That's the price of the stock. What's the term of the policy?
Whatever you pick.
Pick up what?
Like what you put the end date as, because you get to choose, right? And the longer away, the more expensive.
Exactly. Yeah. So it's basically the maturity, the expiration date, right? So basically, let's say if the option is going to expire 3 months from now, then the term of this policy, this insurance policy, is going to be a 3-month insurance policy, right? What is the maximum coverage? How much you're covered in this insurance contract? How much you are covered for?
330?
3 what?
Would it be $330 or $15?
Well, you only have 2 numbers over there. Try again.
315?
What is intuition?
315?
Exactly. Well, that's right. So basically, that's the exact amount you are covered for, because you are entitled the obligation to sell that to sell the Facebook at the level of 315, right? What is the deductible? How much you can lose before the insurance kicks in?
$15 a share.
Where does it come from?
It's currently trading at 330, and if the price were to drop to 315, you'd lose 15 per share. So
exactly. Thank you. That's exactly the point of the deductible. Okay. So the maximum you can lose is $15 per share. Okay. What is the insurance premium?
the cost of the option.
Exactly. The price of the put. Beautiful thing, right? If you look at this thing, from the insurance perspective, it's exactly the insurance. But there is I have to say there are a few tiny differences between the traditional insurance and the put option. Okay, so obviously for any insurance, let's say the auto insurance, you cannot early exercise, and you cannot transfer your car insurance to someone else. And there are no dividend being paid from your vehicle insured, right? So, but the structure, the pricing structure is quite similar. And at the end of the day, you can actually convert all the put options to be a form of a cost in the end, other financial assets. Okay, I will show you that at the later lecture today. So but the point of this slide is just trying to, I'm just trying to convince you that you can view options as a form of insurance. Okay, hopefully that gives you some sort of a general idea in terms of the structure. Okay, and the other, here I want to highlight another definition, and that is the European option versus the American option. So European option basically, let me put it in this way. So the difference between exercising the option at the maturity date versus exercising the option early is virtually the difference between the European option and the American option. So basically for European option, you can only exercise the option at the maturity date or the expiration date. Whereas for American option, you can exercise it anytime prior to the expiration date. Okay, so this is the major difference between these two forms of option. So because of the flexibility over there, usually the American option is more expensive than the European option. Okay, so the other thing I want to show you guys is basically I want to let you guys know how the options are quoted in the real world. Usually, this is what we call the option chain or option matrix. So basically, this is the option information for the Apple. You can see there are lots of dates over here, the yellow dates. Okay, so these are the expiration dates for a series of options. Okay, on December 3rd, you have quite a few substantial amount of calls and puts. Okay, on the left-hand side, under this matrix, these are the calls. On your right-hand side, these are the puts. Okay, so sorry. Okay, so these are the individual prices quoted on the from the broker. Likewise, on your right-hand side, these are the prices quoted for the puts. Okay.
Those prices, are they per stock that you're covering, or is that for a group of stocks? Like, is that for 83 stocks? It only costs $8 on the top.
Okay, for example, if you're looking at December 3rd, strike of let's say at a money call of 150. The 3.60 cents means that for every one share, that call option worth 3.60. Okay, but for each contract, each transaction, it has to be $100 shares. Okay, so when you want to enter this contract, you have to pay $3.60, which is your call premium, to get the option to exercise the to exercise your option at the level of 150. Okay. So this is per share base.
So it would be $300 or $36 for 100 of them, even though it's only a 20-cent difference from today.
Yes, yes. It's on the one contract. It consists of 100 shares of stocks.
Okay.
Yeah, it's just a convention. Okay. All right. So that's virtually how we, quote, the options. And so the purple one is what we call the in-the-money option. So in-the-money calls and in-the-money puts. The black ones are the out-of-money options, which means that, let me show you this. So in-the-money options refers to the options where if you exercise the in-the-money option, it will result a positive payoff. If you exercise the all the money options, it will result in a negative payoff. So if you look at the graphs over here, it's going to be very straightforward. Okay, you will only exercise your call if the stock price is greater than the strike price, right? Think about this thing carefully, right? So likewise, you only exercise your put option if the price is under this range, is within this range. For at the money call, it will generate a zero payoff over there. Okay. And the other pair-west concept is what we call the intrinsic value versus the extrinsic value. Okay, so intrinsic value is virtually the difference between the strike price and the option market price of the underlying asset. Okay, so this component cannot be taken away, whereas the extrinsic value, which is the also we call the time value, is some sort of considered to be a time variant. As time goes by, this part of a value is decaying over time. It's going away pretty quickly. Okay. So by showing you this, I just want to decompose the option value into two components. Okay, intrinsic and extrinsic. Okay, so actually there could be a very deep discussion within the option value. Actually, there's a full course devoted into the valuation of options, but unfortunately, in today's lecture, I won't be able to take a deep dive into the option premium. But I just want to let you know upfront that there's a time value component associated with the option. Okay. So any questions before I move on in terms of this option basic concepts? So you have calls, you have puts, okay? And you can convert a call to a put. You can convert a put to a call using a series of methods. And well, you can also long a call. By long, I mean buy. Short means sell. Okay, so you can buy a call, buy a put. You can short a call, short a put. Okay, let me show you this diagram over here. Okay, if you are longing a call, virtually you are subject to a payoff like this. Okay, you are only going to exercise your option if and only if the stock price is greater than the strike price. Okay, suppose the strike price here is $50. The underlying is a piece of stock. You will only exercise your long call if the stock price is going beyond $50 at the expiry or before the expiration date. Okay, say the stock you are holding 2 days prior to the expiration is at the level of $70. Well, obviously you can exercise your option to ensure the $20 price difference. Right? Now, how about the other end of the spectrum, the short call? Let's say if you sell a call option, what's going to be your payoff looks like? It's going to be the reverse. How to interpret this diagram? Can any one of you help me to nicely reinterpret the call option under the short context?
Is it the exact opposite? Because whatever the person who does the other one gets paid comes out of the pocket of this person that does the short call?
Exactly, thank you. So basically, let's say if you are selling a call, you are obligated to sell 100 shares if the stock price is going beyond the pre-specified the exercise price. Okay, so let's say if you do not hold any positions for that stock and you are shorting a call option on that stock, it's gonna be the most. I mean, that's probably the riskiest practice that I can think of. Okay, because let's say if the stock price is going up like 80%, well, probably your short call is gonna be 800% loss. Okay, if you do not have the position to cover that. Okay, so virtually you have to pay the you have to sell the 100 shares at whatever the pre-specified exercise price is going to be. Okay, so that's the inverse of the long call. The long put is going to be the asymmetry of a long call vertically. Okay, so you can see if you are buying a long put, if you are buying a put option, virtually you can sell the stock at the pre-specified price. Okay, so you really want to see the fact that the stock price is going down. Okay, likewise for the short put, you just need to excuse me. You just need to flip the image.
Can you explain again one more time why you want to lose money on the price as a put?
To be more precise, I don't want to lose money. Okay, so think carefully of the definition of a put option.
Mm-hmm.
Okay, you have the option to sell the underlying at a pre-specified price level. Okay, so for example, if your strike price is $50, hey, that's exactly what we have on the diagram here. And the stock price, let's say 3 days from now, it drops to $40. Now, if you are holding a long put, you have the option to sell the stock at 50, whereas the market price is 40. So you have $10 profit over there, right? You're not going to sell the stock at the 50 level if the price is 70, right? That's kind of counterintuitive and irrational.
Oh, so you don't have to sell it at 7 or at 50?
Well, for any one of this, you are not obligated to enter the transaction. Okay. I shouldn't say that. For the long positions, you're not obligated to either buy or sell, right?
Mm-hmm.
For the short, it's kind of a different. But my point is, if the stock price is greater than $50, you're not going to sell low, buy high, right? That's
then you would just
very irrational, right? We want to buy low, sell high, right? You don't want to do the other way around.
It just looks like on this diagram, you go from having $20 of profit to 0. So
no, you shouldn't. Well, it's true, by the way. If the stock price, let's say, going all the way up, you don't profit anything from this long put. That's true, though. It is exactly the point of this, pricing structure. It's nonlinear.
Okay.
I'm not sure whether I explain your question clearly. Well, you're totally correct. If the price is going all the way up, you don't profit anything from this put. The long put.
So this just doesn't factor in like extra or less than, like with fees and stuff.
Okay.
Right?
Think about this. All right. So think about your car insurance. You insure your car at whatever level, the exercise price, but you don't want to collect a premium from your insurance. You don't want to, let's say, you don't want to run into other accidents just for the benefit of collecting the insurance premium. You don't want to do that, right? So
Yeah.
your upside is limited, is capped, right? It's not like, well, for example, you buy the car insurance. You don't want to, I mean, the point of your car insurance is not giving you a decent amount of a return. It's just trying to protect your downside. That's exactly the point of this diagram.
Okay, that helps.
Right? All right. Hope my explanation helps you a little bit. And the other one more graph I want to show you is this one. Okay, you can see the return on the options and the stock is quite different. If you look at the return of a stock, it goes up by whatever dollar. It returns you to whatever percentage. The point is, it's a linear thing, right? It's a 40. It is a straight line over here, whereas the option return is nonlinear. Okay, so this is actually a very first time you have seen some financial instrument that gives you a nonlinear payoff. It's kinked. All right. So before the underlying hit the exercise price, you gain nothing. Okay. And it's slowly picking up once the exercise price is smaller than the underlying market price. Okay, and the returns difference is huge. Okay, later on I can show you some kind of real data. Okay, so over the next 10 or 15 slides, I'm going to show you a series of combinations of options which can, allow us to produce a few meaningful payoff diagrams that allow us to, preserve capital or properly manage the risk and generate income. Okay, so I think it's gonna be very interesting if you think about how we combine different types of options in terms of the strike price and the maturity date or expiration date. Okay, and it's going to be very meaningful when we apply them into the valuation. Okay, so the first one, let's take a look at this simple combination. Okay, suppose you hold 100 shares of stock. All right. And then you want to short a call option. Okay, you want to sell a call option on that underlying stock. Okay, this is what we call the covered call. All right, so I know it's a little bit counterintuitive, because if you long a stock, it means you are bearish. You are bullish. Whereas if you are shorting a call option, because call option is bullish as well, I mean, the outlook should be optimistic. Otherwise, you shouldn't buy a call option, right? If you're shorting a call, basically you are taking the bearish outlook on that underlying. So why you want to, take both the bearish and the bullish view on the same underlying? Can any one of you give me a sort of a intuition in terms of this combination?
It reduces risk.
Manage of a risk in terms of what?
Value.
I know you're trying to manage the risk in terms of the hedging, right? I think your
Yeah, like-
intuition is right.
Mhm.
Okay.
Mhm.
Okay. Yeah, that's right. If the stock price is going up, the value of sorry, if the price of stock is going down, the call option value will be going down. So the short call will generate a positive stream of income for your portfolio, right? I
Yeah.
think that's your intuition, right? All right.
Yes.
Now,
Mhm.
let me ask you this. What is the downside? What is the maximum risk for this combination?
Well, shorting risk is like almost infinite, right? And I mean, yeah, shorting is almost infinite, right? If it keeps going up, then you get losses if you're trying to short. And longing, I mean, I actually kind of confused myself for just then.
Okay,
Yeah.
so we need to be a little bit careful when we use the term hedging. It's right, to some extent, you're hedging a potential, uh, uh, the downside just to a limited amount. But if you think carefully of this payoff, okay, so this is a typical structure of the stock payoff. I'm sorry, let me check. All right. So if you look at this payoff diagram for the stock, it's a 45-degree line, right? If the stock price going up by $1, then the payoff increased by $1, things like that. Now, you're writing a call, you are selling a call. Well, look at this. The payoff will be a linear, non-linear structure like this. All right. Your downside will be very huge. Okay, you didn't protect your downside actually. Protect to some extent, just the option premium. Over there. Okay, but the stock price theoretically can drop to the zero territory. Right? Okay, so, but I have to say, this kind of a combination, this strategy is one of my favorite strategies. Okay, the reason is that it's very effective if you are taking a neutral to a bullish view on the financial market, especially if the market is functioning well. Okay, so basically, let's say if you are entering a structure like this, what you are hoping is that, okay, let me put it this way. There are two groups of people. Okay, one group of people, they just hope that they have their fingers crossed for the fact that the stock price is kind of neutral, okay, flat, okay, so that they can regularly sell the calls and collect the premiums. Okay, there is another group of people. When they sell the call, they want to sell the stock. They want the stocks to be called away. All right, so it's actually an effective way to sell your stock to to realize your profit. Okay, and also, of course, it can help you to generate income. Okay, so I do have sort of questions for you to think about. If the stock price is moving beyond the stock price, a strike price for that short call, what are you going to do? If that happened, your call will be producing a sort of a loss, right? At this moment, what should you do? Think about this thing carefully. I mean, you are selling a call in the hope that you can generate income to collect a premium, but unfortunately, it, like what I did last week, right? I told you the example on the Tesla. I lost a lot. But so what should you do at this moment?
Either buy new stock or just give it to them and start over again.
What do you mean by to buy the stock?
If you have to sell all
You hold
of
the stock, so you hold the stock, so you actually own the stock. Why you want to buy additional stocks?
because you have to give them away, right?
Yes, exactly. That's right. But my point is, it's very capital intensive. And if you want to buy additional stock, it doesn't help, right? The loss already is already there.
Then do you just like eat the loss and get over yourself?
Well, that's actually that's considered to be typical things to do. Okay, some people they prefer to buy back the option because they consider their stocks to be not touchable. Okay, they don't want their stocks to be called away. There is another group of people, they just want to liquidate the position. They want to sell the stocks. Okay, so this is what I sum up to be the two important philosophies when we come into the management of stocks and options. The first philosophy is what I call the stock ownership philosophy. Okay, if you are buying back your stocks, if you are buying back your losing calls, okay, if you're buying back your losing option to avoid the potential assignment of the sale of the stocks, virtually you view yourselves as the in the position of a stock ownership. Okay, you just want collect the premium. You don't want your stocks to be called away. The other form of philosophy is what we call the total return philosophy. Okay, I don't really care about either the stock or either the options. I view this thing as a portfolio. We look at the covered return. So in other words, when we are implement this kind of a combination of options and stocks, the moment you sell your call, your return is fixed. Okay, that's why I consider this thing to be a very effective way to sell your stocks. Actually, I can show you a quick example when it comes to the actual management of your position. Okay, so I personally, wait a moment, analyze. All right, I personally, I used to invest a lot in the Caterpillar, which is a leading giant in the manufacturing industry. But recently, I don't think, by recent, I mean from since this summer, soon after the news of the dividend increase of a Caterpillar, the stock price dropped a lot. So I started, liquidating my position. And I think that's, 2 days ago, soon after the news of the passage of infrastructure abuse, okay, the stock price increased by like 3 or 4%. And I do want to liquidate all my positions in the Caterpillar. Okay, all right. So what I was doing is to sell the in-the-money call on the Caterpillar. Okay, so I don't care about the the premium. I just want to get rid of all my stocks at this moment. Okay, obviously, well, actually, you know what? I think I wasn't very. I was too conservative actually. I set the stock price, the strike price at the level of 205, but actually I should it should be even more deeper in the money because I feel like the stock price should be very neutral in the short term. But my point is, anyway, the payoff structure of this thing is like this. Okay, if you are shorting a call, you are basically collecting the upper premium over here. If you do not want to liquidate the position, you are incurring a huge amount of opportunity risk. Okay, if the price going up by a lot, you can see your upside risk is gigantic. All right, so that's the idea of shorting a call option. Okay, any questions? So the opportunity cost is huge if you don't want to liquidate your position. But by the way, there could be a very, there are huge concern in terms of the tax implication when you are shorting options over here, because IRS has a very vague definition in terms of the tax payment schedule when you have short positions in your option portfolio. Okay, so if you're interested in that, take a look of my optional reading material at the very end of lecture notes. Okay, I have a diagram over here and summarize the tax implications when it comes to the option transaction, which is very nasty thing. Okay, if I if I am working on options, I have to print out the table to see if it's appropriate to do that from the tax perspective. Okay. Anyway, so the other interesting, actually, I have gone through this diagram for you already when we talk about Facebook insurance. Okay. So if you look at this diagram, it's also very interesting. So basically, you are longing a stock and a put simultaneously. Okay, so it's a simultaneous purchase of a stock and a put. Okay, you are insuring your asset by introducing a put option. Okay, so your payoff is like this. So it seems like you get the best of both. You have unlimited upside, but you have limited downside, right? Now, can any one of you tell me why don't we do this all the time? You
It
get the
really
best
does
of both.
like a good
Huh?
idea, but everyone keeps saying it's dangerous. Dangerous.
Dangerous in terms of what?
Like you could lose like a lot of money if you have like options in general, right?
Well, it's true partially, but in this case, well, obviously your downside is protected, right? So it's a risk-defined strategy, right? You don't have, downside risk. You're completely risk-defined. So
Oh, the cost of doing
exactly.
that over
Thank
and
you.
over again.
Exactly. If you really want to use the term risk, probably the risk is the potential that your put option will become worthless. But when you enter this type of structure, you're in the hope that this put option is going to be worthless. Okay, you want to take the neutral to bullish view when you are holding a structure like this, especially when you are nervous. Okay, so whether you are going to take a protective put position, it depends upon how nervous you are. Right? And there, like I said, there's no free lunch. You have to pay for this structure. Okay. And actually, if you look at today's data, let's say the stock market, if you look at the SPY, how about this? Let's look at the QQQ. The tech sector is dropped by 1.5% in terms of the price level. Okay. Well, if you look at the put option, the insurance like this today is much more expensive than you have in the last few sessions. Okay, so wait a moment. Where is the percentage change? Anyway, I want to show you guys the. Anyway, so my point is the percentage change of this put option should be around at least 30 or 50%, which is huge. Okay, so it really depends upon the overall market condition when you think of this kind of combination, this insurance strategy. Okay, this is the idea. I mean, of the comparison between the stock and the protective put on the stock. Okay, you can see the limited downside and unlimited upside. Okay, But for this kind of a contract, you have to pay for the option premium. Okay. Now the other interesting combination is like this. Okay. So you're going. Oh, sorry, there is a minus sign on my screen. So call 1 minus call 2. Okay. So you're going to buy a call option at a lower strike price. In the meantime, you are going to sell a call option at higher strike price, which results you a payoff diagram like this. Okay, so I know it's very ridiculous. Okay, why anyone in this world want to cap the upside premium, upside return? Why you want to give up your upside return over here? If you don't do this, you have unlimited upside, right? Think about this thing carefully. Why you want to do that?
Because if you can buy the stock back for less than you sold it, awesome, but you're not required to. So technically, you only lose like a small amount if it doesn't go below that threshold.
I think I'll appreciate it if you can rephrase your what you are saying. So the idea of this thing over here is that you are using the short call to finance your long call, right? By shorting this call, you are collecting the premium to finance the long call you are going to purchase. And it's less capital intensive. You don't need to, collateralize 100 shares over there to, implement whatever strategies. You can just, buy a call and a short call with higher price. This is what we call the long call vertical spread. So basically, you can see the strike price of the two calls are different. We are betting on the fact that the stock price is going up. Okay, so in other words, the opportunity cost in this case is the potential upside. You give up the potential upside to finance your long call. All right, so that is your opportunity cost over here. You know what I'm saying? So this is what we call the long call spread, and there are some other forms of a spread, like if you are simultaneously buy and sell strike at different maturity dates, this fall into the calendar spread family. Okay, if it's different strike and different maturity dates, this is what we call a diagonal spread. But that's too fancy for me to talk about in this lecture. Okay. So you can actually, no matter for the vertical spread or the cover call, you can always, extend the durations for these combinations, which can be meaningful for you to manage your portfolio. Okay. All right. So any questions? The very last diagram I want to show you in terms of a combination of options is this thing over here. Okay, I think this is very useful when we have a market condition that's going to be very volatile. Okay, so you simultaneously buy a call and a put at the same strike price, okay, which gives you the payoff in the form of a V shape. Okay. So what is the implication of this? what kind of a company or corporate events should we focus on when we are using this type of strategy?
Would you use it like during earnings reports, stuff like that?
And well, sometimes maybe true, yes, because right before the earnings announcement, the implied volatility usually it picks up pretty quickly. Well, actually, not necessarily this strategy because right after the earnings announcement, there are usually a crash on the volatility. So the value of this thing is dropping. Okay, so when we talk about options, price direction is only one thing. Okay, the volatility is also very important. This strategy right here on this screen probably is the first time that allow us we are allowed to bet on volatility. Okay, we don't care about the price directions at this moment. We only care about whether the stock price is dropping by whatever percentage or picking up by whatever percentage. Okay, so if you are looking at the price of this kind of strategy under a volatile market, it's going to be very expensive. Okay, so we use this kind of strategy usually for some complex corporate events, especially let's say for example the litigation. Okay, so whenever there is a corporate lawsuit filed against a firm, for example Facebook, there are lots of litigation cases over there. You're unsure about a potential the outcome for that court filing. So the price of that firm's over the next before the settlement date is going to be very volatile, whatever. You may be think about implementation about this strategy to capture the potential volatility out there. Okay, so like I said, this is the very first time we're seeing this kind of a structure that allow us to bet on the volatility. Okay, which is completely different from the payoff structure we've seen in other forms of corporate securities. Okay, all right. So over the past few slides, I want to now I want to convince. I'm trying to prepare you the way to look at this, what we call the put call parity, which means that all the call options can be converted to a portfolio of puts. Okay, and it's very meaningful when it comes to the valuation. Okay, think about this thing over here. Suppose you are simultaneously buying a stock and a put. Okay, so basically a protected put. And the payoff structure is like this, right? We went through that already. And think about the other combination. We are going to buy a call option and the zero coupon bond at $50, same strike. Now, you're going to yield the same payoff diagram, exactly the same. So basically, you are replicating the portfolio over here by buying a call and a zero coupon bond. Now, what I'm going to show you is that virtually you can equate these two strategies. Mathematically, you can see the summation of the stock and a put. The protected put is equivalent to a call plus a zero coupon bond discounted back by the risk-free rate, right? We learned that in the very first lecture in this semester, time value of the money, right? So basically, the call option can be priced as this. Okay, it's a portfolio of a stock, put, and a bond. All right, this put call parity is extremely powerful when we when it comes to the valuation for option derivatives. All right. So, and actually for any pricing structure you can think of can be approximated by portfolios of calls and puts. Okay, that's the beautiful thing of the nonlinearity feature of option over here. Okay. The very, I think I run out of time. The other thing I want to mention is the implied volatility. Okay, so like I said, I think that's Marco, right? I mentioned that right before the earnings announcement, there are lots of things going on. Okay, if you look at the large tech company, high tech companies over the past probably past 6 quarters, well, you can see there are always a pre-run right before the earnings announcement. The price is going up and the volatility is going up. Okay, right after the release of a earnings announcement, the earnings call, well, the price is dropping and the volatility is dropping. Okay, so by implied volatility, it is something different from what you observed from the historical data. Okay, so historical volatility is what you are, acquiring from the historical stock returns, whereas implied volatility is sort of a forward-looking measure. Okay, you may think this is sort of a chicken and egg question. Which one comes first, price or implied volatility? Well, in reality, it is determined by the market. Okay, one way to think about this is you can look at the money calls and puts, and you can look at the demand and the supply of the overall market, which is a sort of a price discovery mechanism that allows you to get the add the money put price. Okay, then you can use a variety of other mathematical approaches to get the implied volatilities for other options at different strikes. Okay, so implied volatility is the volatility embedded or implied in the option price, which is a forward-looking measure. And there is actually an index that captures the implied volatility of the market, okay, which is VIX. Okay. All right. Actually, in financial academia and the financial industry, people usually, always trying to, capture implied volatility in a more effective way, because if you do that, your model will be much more powerful in terms of the predictive power. Okay, so this is a time series of the implied volatility up to this year. You can see the implied volatility of the overall market is huge when it comes to the coronavirus last year, right? Oh, this slide is kind of interesting. Okay, so like I said, in the academia and industry, people are trying to come up with a sort of a alternative measure or whatever proxies that could be meaningful in capturing the implied volatility. Okay, so groups of scholars from University of Chicago, they actually come up with an interesting measure that shares the same spirit of implied volatility, which is what we call the economic policy uncertainty index. Okay, so basically what they're doing is they employ 1,000 students from U of Chicago reading the newspapers, okay, grab the keywords of newspapers like something like fiscal policy, monetary policy, whatever, negative keywords, and they count the number of those news article negative, keywords that are associated with negative sentiments, and they generate this sort of, economic policy index, uncertainty index, and it works pretty well in terms of the prediction of the VIX. Okay. Of course, there are many limitations of this index, but actually nowadays it's also widely used in the industry and academia, okay, which captures some, the value of the volatility forward. Okay, so they test the predictive power of this EPU index. Actually, it's very significant. This is the diagram I draw from the Federal Reserve website, data website. You can try to play with this index to see, the overall sentiment centered around the economic policy. Okay, I think I run out of time. Next lecture, what we are going to do is to finish the discussion of the option. I will talk about the firm value that can be expressed in the form of a call option, and the liability, corporate liability, that could be expressed in the form of a cover call. Okay, and then we will talk about the capital asset pricing model and the overall capital market. Okay, so do you guys have any questions before I call it a day? Now, like I mentioned, I did give you guys some sort of a extension reading material for this chapter. So everything after page 43 are not required in this course, not required by this course. It's just up to your personal interest. Okay, so basically it's the valuation of options. And I have an Excel posted, which is a very interesting application in the area of corporate finance and M&A. Okay, so if you're interested in that, check out those extension material. If not, that's totally fine, which is not required by this course. But that's all what I have for today. Do you have any other questions before I end the session?
Oh, yeah, that stock market game thing, the report. When does it do again?
Huh? Oh, yeah. Let me. Okay. The session will be ending December 5th, I think.
Oh, okay.
December 3rd, but the report here will be due. Let me see. I couldn't remember because I'm teaching multiple. Okay, it's going to be due December 5th.
Okay.
All right.
Okay.
All right.
Sounds good.
Any other
Thank you,
questions? All right, so if you don't have any questions, I will end the session and post the recordings tonight. All right?
Thank you.
Everybody all,
Thank you, Professor.
Have a good night, Professor. Thank you.
thank
Thank
you.
you, Professor.
I'll
Thank you,
see you
Professor.
guys. See you guys next week.
Professor?
Yep, go ahead.
Yeah, I have a question on the report on the stock. So what should I do with that?
You have a question on what?
For the report, the final report on the trading game?
Oh, yeah. Uh-huh.
Yeah. How can I do that?
So-
Like, I don't have any idea.
Yeah, I think on my syllabus, I did have some sort of instructions, right? Did you look at my syllabus? It's over
Check it
here.
again.
I'll show you. So let me share my screen.
Yes, please. Thanks.
Can you see it? Yeah, so basically I want you to think about why you are picking up this company. Okay, why you are choosing this company, and whether this position exceeded your positions. Exceeded your expectations. All right. So what are the how to say what's your thought in terms of the overall market outlook? All right. and what you learned from this trading experience under the context of corporate analysis.
So basically, you should answer the question, right?
In the report format, not just answer a few sentences, right? So it's more like it's a 3-page paper, right? Paper is the right word, not a short answer.
All right. Thank you.
Yeah, I'm not very picky. I'm not very picky in terms of your writing style, but just want to. I really want to see you develop some sort of a intuition and experience in this activity.
Copy.
Right.
Thank you.
All right, and your performance will not be matter. I mean, it's not. I mean, will not determine your grade. I don't care whether you lose for 50% or gain 20%. But I really want to see your investment philosophy.
Copy.
All right.
Thank you.
Professor?
Okay. Yep.
I also have a question on the report.
Okay, go ahead.
Tonight you mentioned to incorporate discussion on overall market. So would that be on a certain day, or I'm sorry, I just not.
Well, let's think about this. If you look at if you follow the market, what are the key topics nowadays? Inflation, labor participation, real estate. What else? Let's see. COVID-19 economic recovery, right? Remote working. So we really want to, think about how this kind of news can be priced into the companies that you are interested. Okay, so I think there are pretty much. I mean, there are lots of flexibility over there in terms of how you structure your discussion on the market outlook. I think there are, how to say, it really depends upon what kind of, companies you want to focus on. Okay, so for example, the energy territory is completely different from the high-tech companies. And for high-tech companies, it's going to be completely different from the some sort of growth stocks like Peloton, which benefited tremendously from last year lockdown because everyone wanted to work out in their home, so their sales were pretty good. But this year, if you look at their stock performance over the past 3 days, it dropped by 60%. So what's going to be the market outlook for that general industry? Well, it's going to be, obviously, it's not very promising, right? But if you look at some other manufacturing or whatever retails, probably it's going to be good because of the holiday season and whatever other sort of a market sentiment. I mean, there are lots of things you can talk about. I don't have very detailed specific requirement for that. I can give you a list of things, but I don't want to restrain your thoughts when it comes to your development of your own investment philosophy.
Okay, thank you, Professor. But if we
you can when you have an initial draft, you can send it to me. I can go over it for you to see if there are anything you can improve.
Oh, okay. So the initial draft, do you want it an outline form, or is it okay if I write it out and then you can read it, my initial draft, or?
Whatever work. I mean, make you comfortable. I'm fine. Yeah.
Okay, great. Thank you, Professor. And if we want to meet, we can just make an appointment or just show up on your.
Yeah, either office hour. If it doesn't work for your schedule, just send me an email.
Oh, okay. So your office hour, we could just.
Wednesday 3:30 to 5:30.
Okay, great. Thank you so much.
All right. You're welcome.
Good night.
All right. Good night. All right.